All right, let's get right into it. If you're a creator, a freelancer, maybe even a retiree who's earning royalty income, listen up. There is a hidden financial tripwire that you absolutely need to know about. Seriously. It's a trap that can take what you think is safe, passive income, and turn it into a massive, completely unexpected tax bill. So today, we're going to break down exactly how to spot this thing, and more importantly, how to make sure you're protected.
So let's start with this number, $70,000. Now this isn't some made-up number. This was the actual, shocking, out-of-nowhere tax bill that hit a software developer we'll call Sarah. She was sure she had done everything by the book, but one simple, tiny mistake threw her into a massive financial crisis.
So you have to be asking, how does that even happen, right? How can a single piece of paper, a simple classification, lead to such a disaster? Well, the whole answer is in how the IRS looks at your income. And for Sarah, it all started because her royalty income was reported on the wrong form.
And that brings us right to the heart of the matter, what I'm calling the $70,000 tax trap. The entire problem hangs on this critical, and honestly often misunderstood, difference between two very specific types of income. Getting this wrong is what sets the trap.
And this is the number that matters, 15.3%. That is the self-employment tax rate. And it is the one thing, the one economic gap that separates passive royalty income from active work. This is the tax that Sarah suddenly got hit with. And it's the one you want to avoid at all costs if your income is truly passive.
So look, this breaks it down perfectly. Think of two different worlds. On one side, you have non-employee compensation. That's for active work you do. It gets reported on a Form 1099 NEC, and boom, it triggers that 15.3% self-employment tax. But on the other side, you have royalties. That's passive income from your property. It's reported on a Form 1099 MISC, and it generally has no SE tax. The form your client uses to pay you, well, it makes all the difference in the world.
And here's where it gets really tricky. The IRS has these automated systems that create what our source material calls a split reality. Basically, if your income gets reported on that 1099 NEC, the computer just assumes you owe self-employment tax, period. The burden is instantly on you to fight it and prove that you don't, which creates immediate financial stress.
So, the whole game is about understanding how the IRS defines your involvement. See, it's not about what you call your income. It's about what you do. That fine line between being a passive owner and an active service provider, that's where people get caught.
This brings us to a key concept, the active participant trap. The IRS has the power to reclassify income that you believe is a passive royalty and treat it as active compensation if they decide you are materially participating in generating it. And that is exactly what happened to Sarah.
Let's look closer at Sarah's situation. Sure, she licensed her software, but she also provided technical support for it. She was actively marketing it on her own website, and she was regularly pushing out new updates. From the IRS's point of view, those are not the actions of a passive owner just collecting a check. No, those are services, and that reclassification is what triggered that huge tax bill.
So how does the IRS even find these cases? I mean, it's not random. There are very specific red flags and automated triggers that their computer systems are built to look for. And if you hit one, it can land your tax return right under a microscope.
And here are the big ones. First, inconsistent reporting. This is huge. It's when your client sends you a 1099 NEC for services, but you turn around and report it as royalty income on Schedule E, hoping to dodge the tax. Second, there are specific error codes, like IND 507, that are designed to flag exactly these kinds of mismatches. And third, sometimes just reporting your royalty income on the wrong schedule is enough to get you noticed.
You know, the stakes here are especially high for retirees. Take a look at this. The projected 2.8% cost of living adjustment for Social Security in 2026 is supposed to help with inflation, but an unexpected 15.3% tax hit on what you thought was safe royalty income, it doesn't just cancel out that benefit, it completely demolishes it, creating a sudden and serious cash flow crisis.
And for you higher earners out there, the potential damage is massive. In 2026, the maximum amount of earnings subject to the Social Security part of the SE tax is projected to be $184,500. If you misclassify a big royalty stream, you could end up owing that 15.3% tax on a very, very significant chunk of your income.
So how do you defend yourself? Is this just unavoidable? No way. Let's look at our second case study, a guy we'll call Mark. He's the architect.
He proactively structured everything from the very beginning to make sure he never fell into the same trap that caught Sarah. His approach is pretty much a masterclass in how to do this right.
Mark followed a really clear four-step protocol. First, he structured his licensing agreement very carefully to separate the payment for property rights from any payment for services. Second, he clearly defined and separated what his duties were. Third, and this is a big one, he kept a detailed activity log to prove his involvement was limited. And fourth, he thought about the right business entity from day one.
Now, part of Mark's strategy was using an S-corporation. This is a pretty powerful structure. It lets you pay yourself a reasonable salary, which, yes, is subject to employment taxes, but then you can take the rest of the profits as distributions. And those distributions are not subject to that 15.3% self-employment tax. It's a game changer when it's structured correctly.
And please remember this quote. If you take away one thing, this is it. The IRS doesn't have to prove you are providing a service, you have to prove that you weren't. This is why having your documentation in order, having clear contracts, and having a proactive structure like Mark's are absolutely essential. They are your defense.
Okay, let's wrap this all up into a final, actionable checklist for you. These are the defensive moves you can start thinking about today to protect your own royalty income and steer clear of that 15.3% tax trap.
Here's a super simple guide to keep it all straight. The 1099 NEC is for non-employee compensation, think active services, and it's the one that triggers the SE tax. The 1099 MISC is for things like rents and royalties, passive income, and it generally does not trigger the SE tax. You need to know which form you should be getting and why.
So here's your homework. First, go review your current contracts. Do they clearly state that the payments are for the use of your property? Second, start an activity log. Today, document your involvement, or even better, your lack of involvement. And third, if you have any significant royalty income, please talk to a tax professional about your structure.
And that really brings us to the final, critical question you need to ask yourself. Take a hard look at your income, at what you're doing every day. Is that income genuinely passive? Or could the IRS make a strong case that you're an active participant? Answering that question honestly for yourself, right now, could be the one thing that saves you from a ticking tax time bomb down the road.